Hey, this is René, welcome back for another video on this channel, and today I want to talk about leverage, margin, and why trading is different than investing. I did not really think that such a video is necessary, but I realized that many people also watching my videos do not really understand how leverage works and why you cannot really compare trading to investing. So I will also cover topics like margin, how margin is calculated, how much money you can really invest if you have a leveraged account, and how to make use of this and where the risks and chances are, obviously. So first of all, why I'm doing this video is, or maybe I have this go long strategy, which is the easiest strategy that you could imagine. Like I go and have a look at indices, and then the program buys in the morning and sells in the evening. So that's it, pretty much, every single day. So I'm kind of doing the same stuff or similar stuff that a ETF, exchange traded fund, is doing. So I'm just rebuilding the performance of an index, right? Or that's the overall idea. So as you can see here, this is a visualized test. The program really does this every single day. Nothing special here, really. So let's have a look at how this looks in the graph, like the actual performance. So you can see here the graph is going up, which is great. And if the test finishes in a second, we will be able to compare this performance to the actual performance of the index. So here we can see the summary pretty much of all of the trades that my expert advisor did in the test that I just created. And you can see this is the period that I tested for the current year, starting here, ending here. So if we just have a look at the index, we can see the index generated a whopping 8.7%, which is great, while my expert advisor trading system here only created 6.7%, as you can see here, which means that my system is bad, right? And this statement is true if we just have a look at investing. So if we would assume that we trade, or that I trade, this strategy, this expert advisor system with a 1-to-1 leverage. But this doesn't make sense anyways, and this is the whole point of this video. So if we have a look here, we can see my test just generated a profit of 6.8%, while the index made more. Also, I need my program and I need to run a VPS and everything. So it would be way easier to just use a exchange traded fund, right? A ETF to get this performance. But you made the calculation without leverage, because I can easily increase my leverage. And then I will create a whole different performance. So if I create another test or do another test and I increase my risk a bit, which is possible because this is a leveraged account, we will see that the performance looks way different. And this is also an answer to all of the people that always say in the test, like 10% is not enough over a period of 1 year, or 20% is not enough, or 30% is not enough. All of these comments are a little bit, I don't want to say stupid, because most people are just uneducated and not actually dumb. But it does not really make sense to have these statements or to make these statements when you talk about leveraged strategies, because you can just create or increase the risks and you will increase the outcome. And this is what we see here. So you can see this was exactly the same test, but now I'm easily outperforming the index with my strategy. As you can see, my strategy, it's the exact same strategy, everything's the same, the trades are the same, but just the risk is higher, and my outcome is a lot higher than the index. Here I made 5% more than the index. And I could play this game like even further. I could go and increase the risk even more. And if I do the same test, the outcome is even better. And this is a little bit of course, this is not the whole story. Like whenever I increase the risk, I obviously also increase the chance to fail. Like I could blow my account, of course, because I increase the risk. And this is one important learning that many people need to understand, and this is basic economics in the end. But people have to understand, whenever you trade and you have a strategy that creates more revenue than another strategy, like not in all cases, but in most cases, the strategy that creates more revenue is trading at a higher risk than the one that is creating less revenue. This is like a general rule of thumb. Of course, there are exceptions and everything, but this is how economics work, because you never get reward risk-free. And this is an important learning that people really need to understand. So what we learned so far is that when we trade, we can make use of leverage. And honestly, we should, because otherwise we can just invest and have a better risk-reward ratio than if we trade. Because you get this leverage from your broker, but you don't get it for free. And this is the second part in this video that I want to talk about. And here I want to explain how leverage actually works. So when you leverage your trading, let me close this, we don't need this anymore. Like when you leverage your trading, you sort of rent or lend money from your broker. So you say, for example, you go to a broker and you have 1,000 euro in your account, but you want to leverage these 1,000 euro. Then your broker might say, okay, come here, I give you an account with a leverage of 100 or a leverage of 500 or leverage of even 20. This means that your 1,000 euro that you do have in the bank are worth 100 times the amount, or 500 times, or 20 times. And this is up to the leverage that you have in your account. So let me give you one example. For example, here you can see in the navigator, I go to scripts, examples, account info sample. And I think this script should be in every MetaTrader 5. I'm not sure, but yeah. If you activate this, you can see the leverage of your account in the upper left corner. Here you can see my account that I'm running here right now has a 1 to 100 leverage, or a leverage of 100, which means that if I have, let's say, 100,000 euro in or US dollar in my account, I could invest 100 times this sum, which would be 1 million, 10 million, 10 million, I guess, if I don't do the math, if I don't mess up the math. So I can invest way more than I have in my account. But does this opportunity come for free? No, of course it does not. There are certain things you have to watch out for. And one of these things is the swap. As I said, when you trade leverage accounts, you kind of lend the money from your broker. And of course, the broker is taking a risk by giving you more money to trade than you actually have. Because if you burn more money than you have, the broker has a problem to get this money from you. Is this understandable? Yeah, I think it's pretty easy to understand. For this reason, for the risk that the broker takes with you trading leveraged accounts, he wants some security. And some of these securities or some of the benefits that the broker wants to have are the trading costs that are usually higher compared to, for example, exchange-traded funds. ETFs are very cheap, and trading Forex and CFD is rather expensive. And this is because the broker has to get something for the risk that he takes. Also, the most typical financing rate or the money that you pay for the broker is if you hold positions overnight. If you hold positions overnight, you pay a swap fee, and this is because, yeah, you can see here for the German index, for example, I would have to pay a fee if I hold long positions overnight. I get money if I hold short positions overnight. And this is because if, like theoretically, if you buy a index, the broker would have to hedge this trade. Like for example, let's say you buy a CFD, or many people buy a CFD with the same broker, let's say of the DE40 or the US 30. So what the broker can do is he can like even out all of the long and short positions that the customers have, but there is some kind of overlay in either one direction. like let's say more people are going long in US30, this would be a risk for the broker. So theoretically, the broker would have to hedge or secure this position by, let's say, buying a futures. And this means that the broker has costs and risks overnight. So for this reason, you also have to pay swaps, like the financing rate for to your broker if you hold positions overnight. So this is another piece of the costs that you have to pay to your broker, because he provides you with this leverage account. But let's have a look at how this leverage or the margin is actually calculated. And I prepared a little example for you. So you can see here I have this one trade open. Right now it's 21 euro in loss. But I also made some screenshots before. So you can see this was when I first opened this position. I don't know. Like what I want to show you is I opened this position here at the price of 1.8641. This was when I bought one lot of Euro US dollar, or I opened this long position. You can see there is no profit currently. So let's have a look at the margin here. You can see the margin that it takes to open this position is 1,806.41. And if you compare this to the price, it's actually like the same. But here I have a leverage of 1 to 100. So what does this mean? If I buy one lot of Euro US dollar, I invest I take 100,000, that's the definition of one lot. I take 100,000 euro and turn them into US dollar, which means that at a price of 1.08641, I get 108,641 US dollar for the 100,000 euro that I invest. But since this is a leveraged account, I do not need the 108,641 euro in my account, which I don't have, by the way, or US dollar in this case. So I only have to provide a margin, which is a 100, like 1% of this, because my leverage in this account is 100. So I only need to provide 1% of the sum or of the invested capital here. So this would be different if my leverage would be 20 only. Then my margin would be 5 times as big. But if my leverage would be 500, for example, my margin would be 5 times smaller, my initial margin. And this is how the margin is calculated. So as you can see, with my account of nearly 100,000 US dollar, I could open positions that are 100 times as big as my balance, because I have a leverage of 100. Also, here I made another screenshot when my position was in profit by 5 US dollar. And here you can see, oh wait, let's go to the first screenshot again. We can also see next to the margin here, we do have the free margin. And the free margin is just the result of a subtraction. So we take the balance and we subtract the margin and we get the free margin. That's pretty much how it works. And now the second screenshot is when my position was 5 US dollar in profit. So here we can see the margin here, the initial margin for my position, it's the same. But the free margin is now 5 US dollar higher. And this is, if we compare it, here it was 323, here it's 328. So if your positions go into profit, this immediately is, your free margin just stacks up and gets higher again. So if you have a lot of positions that are in profit, you can open even more positions because your free margin goes up. And this is because when your positions are in profit, the risk for your broker goes down. Because if you are in profit, you most likely don't lose more money than you have in your account. So the broker is not really at risk to to not get all the money that you burned from you. And there's the other scenario is if your position is is losing. So here, for example, the margin is $20 lower than it was here. Like here it was 323.9 and here it's 303.9. And this is because the position is currently $20 down. Because in this case, the broker is at a higher risk that you might burn more money than you have in your account. And this is also the reason that if your margin level goes down significantly, at some point the broker will start to close your positions, even if you did not burn all your money yet. This is just a safety mechanism for the broker to ensure that you do not burn more money than you have in the account. So you can see this leverage trading just puts a lot of risk on every side, like on your side, on the broker's side. But since you trade with the broker wants you to kind of pay for this risk with higher trading costs and especially also with the swap rates overnight. And this is also the reason, if we come back to my starting example here with trading the indices with my go long strategy, this is the reason why, for example, I created this expert advisor that always buys every morning and sells every evening, because I don't want to pay the swap costs. And yeah, this was a little video to explain how leverage works. And I just want to make sure that everyone really understands that you cannot really compare trading to investing. Like if you just invest, or if you take a trading account and you open a trade with the same size that you would invest into a exchange traded fund, the ETF will always perform better. But this is just naturally, because you don't have to pay the additional fees for the broker to cover the broker's risk. So if you decide to trade, then actually you should make use of the leverage, because if you don't want to leverage your account, then there's not really any need to even trade, because then you would be way better off to just invest your money. And yeah, this is also why in my 50K account that I feature a lot on this channel, I use this really simple go long strategy, even if I know that investing in an ETF would give me a better result. But this is something that I know, and I still use the go long strategy because I leverage my account. And by using the go long strategy, not only in one index, but in 3, and also using other strategies, I still have the chance to outperform the conservative, normal investing strategy that invests in ETFs. But of course, I'm also at a higher risk. But this is also always the case when you trade. Like you are always at a higher risk compared to classical investing. And even though some people might tell you other things, it's mostly just a lie, because the broker wants to have something in a form of fees if he gives you more money to trade than you actually have, because the broker is taking a risk at this point. So I hope this was, maybe some people learned something from it. Just want to get it out there so I can link this video if someone else tells me that a ETF would be the better investment. And yeah, thanks for watching. Have a great time. If you have any questions about this, drop it in the comment section below, and I will be glad to read them and also answer them if I'm able to. I'm out. Have a great time. Good trades. Bye.